Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes weird and always important world of corporate filings. Today we're diving into the latest report from CCO Holdings, which is basically a giant cable and internet company. We'll see if their profits are as strong as their Wi-Fi signal. Hopefully there won't be any buffering issues along the way. This is their Form 10Q, which is like a quarterly checkup on their financial health ending on March 31, 25. The big question is, in a world of streaming and changing technology, can a cable giant still deliver? Let's find out. Before we get to the numbers, it's important to note that this report contains what are called forward-looking statements. Basically, these are predictions about the future. The company warns that many things could happen to make these predictions wrong, from competition to government regulations to just plain bad luck. It's like when you plan a picnic and it rains, you should expect it but never want it. Keep this in mind as we go forward. Alright, time to put on our accountant hats. First, let's peek at the balance sheet. This is a snapshot of what the company owns and what it owes. One thing to notice is the accounts receivable, which sits at around $3 billion. This is the money owed to CCO Holdings by its customers. They also set aside a small amount, about $200 million, to cover the possibility that some people won't pay. The biggest part of their assets is their investment in cable properties, which includes everything from their physical equipment like cables and trucks to intangible assets like customer relationships and their franchise agreements with cities. All told, it's a whopping $140 billion after considering wear and tear. It's basically a massive amount of infrastructure. Looking at what they owe, they have about $10 billion in accounts payable, which is money they owe to their suppliers and other creditors. They also have almost $2 billion a year, which is debt and needs to be paid. But the big number here is long-term debt, a staggering $92 billion. This is money they've borrowed that needs to be paid back over a long time. Now let's move on to the statement of operations. This is like their income statement, which is how much money came in and how much went out over the last 3 months. Total revenue sits at almost $14 billion. So how did they make that money? But running a cable and internet giant is very expensive. Operating costs eat up $8 billion for depreciation. After all these expenses, they are still left with a $3.2 billion profit from operations. But wait, interest is the cost of having all that debt we talked about earlier. It is about $1.2 billion. After some other expenses and a tiny amount for income tax, the total profit ends up being about $1.8 billion. Which is pretty good. It is important to note that all that money goes to the CCO Holdings member, which is Charter. The statement of cash flows is like tracking where their cash is coming from and going. We already know that their net income was about $1.8 billion. But because of certain accounting, that number is adjusted for something such as depreciation. There is also changes in what is called working capital, such as accounts receivable. After all these moving pieces, CCO Holdings generated $4.3 billion in cash from its operations. Not bad. But they spent around $2.4 billion on things like equipment for their operations. They also borrowed about $1.3 billion in long-term debt and repaid $1.6 billion. Finally, they sent almost $900 million to their parent company as distributions. The cash position increased about $361 million. The notes to the financial statements provide more details. We will cover some of those now. CCO Holdings is basically a subsidiary of Charter, so all of its financial results are rolled up into Charter's overall performance. This can make it a bit hard to see exactly how well CCO Holdings is doing on its own. Here, we learn more about those accounts payable and how they manage their payment terms with vendors. They use something called supply chain finance programs, in which vendors get paid early by third-party financial institutions, while CCO Holdings pays later. The total amount they owe under these programs is over $500 million. This part breaks down their debt in more detail. They have different kinds of debt, including senior unsecured notes, senior secured notes, and credit facilities. The total face value of their debt is around $93.6 billion. A small portion of their debt is also in British pounds. This part also gives the fair value, or what those debts would be worth if they sold it right now. Here we learn that CCO uses a special financing setup to handle payment plans for its mobile devices. A separate company, a special purpose vehicle, borrows money to buy these payment plans from CCO, which then uses the cash. It's a way to manage the risk associated with these payment plans. Here we learn about financial instruments to manage risk. They are using cross-currency derivative instruments to protect themselves from changes in the value of the British pound, since they have some debt in that currency. These instruments had a liability of over $500 million. This part breaks down where their revenue comes from. Internet service makes up the biggest chunk, followed by video. Mobile service is growing while video is shrinking as more people cut the cord. They are also making money from advertising and other services. This company operates as one big unit. The CEO looks at the overall performance rather than breaking it down into separate segments. Charter gives its employees stock options and restricted stock units as part of their compensation. This part of the report tells us how many of these awards have been granted. Okay, so what's the big picture here? CCO Holdings is trying to adapt to a changing market by focusing on internet and mobile services. They managed to increase their revenue and profits this quarter, mainly by adding more mobile subscribers and managing expenses. They're also spending a lot of money to expand their network into rural areas, and they are upgrading their network to offer faster speeds. They use adjusted EBITDA to measure their performance and service their debt. We can also see that their debt compared to their adjusted EBITDA is about 4.1 times. CCO Holdings' critical accounting policies are consistent with what they were last year. These policies are what they use to make estimates which affect the financial results of the company. Finally, it's important to remember that there are rules about how much money CCO Holdings can send to its parent company, Charter. These rules are tied to their debt agreements and financial performance, ensuring that CCO can meet its own obligations first. Alright, so let's summarize CCO Holdings. Strengths. Revenue has slightly increased, especially from mobile subscribers, but it seems to be slightly offsetted from decrease in average residential voice customers. CCO is managing to keep expenses down while making strategic investments. Truths and weaknesses. Massive debt load is still there. They are getting creative with financing, but it is something to look out for time opportunities. Rural areas could create additional revenue, as is consumers moving away from cable and other services, government regulations. All they seem to be doing what they can do in a difficult time for cable companies. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more Corporate Decoder deep dives. Until next time.